That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Got Mark Malik, Siebert Financial CIO, as well as Yahoo Finance's very own Jared Blikre joining us here to break down the moves today. Jared, let's start with you on that close.
Well, thank you, Josh. I was just looking at a photo finish for the S&P 500. We can dial that up on the Wi-Fi Interactive behind me. We had a record close on Friday, so guess what? It was in the green. Another record close today, up a whopping 1.16 points, but that's all that counts for a win. Let's check out the Dow Jones Industrial Average, which closed slightly in the green, not by a lot, 14 basis points, or about 64 points to 44,837 and change. And then the NASDAQ just slightly positive, up by about 1/3%. And you can see that rally right into the close just now. And the S&P 600, so that would be the small caps. That was down about 16 basis points today. Another market I was looking at was the S&P 500 equal weighted index. So this assigns an equal weight to all the components instead of the biggest stocks get the most weight. That was underwater by about 0.5% today. So not very good breadth in the market. And the biggest mover I was looking at in terms of influence was the US dollar index. We talked about that an hour ago, up 1% on the day. Also with that, we saw higher yields in the 30-year, up to 4.96%, and the 10-year up to 4.42%. Now let's take a look at some of the heat maps where in sector land, we saw energy on the back of crude oil surging. That was up 1.15%. Then tech and consumer discretionary. Those three were the only in the green today. At the bottom, we have real estate, materials, utilities, and staples. Each of those down by more than 1%. And taking a look at the NASDAQ 100, not a bad looking board here, a little bit more green than red almost looks like. NVIDIA to a record high, up 1.87%. Semiconductors leading the day. Tesla also up nicely, up 3%. AMD was up the most in the NASDAQ 100, 4.32% for that tech stock. And just let's take a look at the semiconductor board right here. We see a little bit of red from Taiwan Semi and Micron and Intel, but for the most part, we were seeing a lot of green across the board. And in software, well, we do have a little bit of red there, but also a lot of green. IBM up over 1%, Oracle also there, Shopify up almost 2%. And I just wanted to get a quick look at the futures board. I did mention crude oil was leading, but palladium up just a little bit more. That's PA equals F, up 3%. For the most part, the metals were down on the day, and you can see that in some of the gold miners here. That's a red board for you. And I will close here on our leaders where we saw small oil, chip stocks, and Bitcoin, interestingly, leading the pack here. To the bottom, we see biotech. Biotech was a big loser on the day on this board. Back to you.
Thank you, Jared. Mark, I want to get you in as well. Now, you say, Mark, something interesting here. You say this is the most important market week of 2025 so far. How come, Mark?
Well, let's start with earnings, of course. You know, this week we have 4 of the Mag 7, and they're not only part of the Mag 7, but they represent somewhere around 20% of the S&P 500's weight. So obviously how well they do really has a major impact on the market. Of course, we have these critical trade deals coming to a head. We weren't expecting the EU trade deal, but it got done, and that's great. But August 1st looms over our heads. That's at the end of the week. And of course, we also get the job situation coming out on Friday as well. That's extremely important. That's one half of the Fed's dual mandate. And speaking of that, we have the PCE price index, that's coming out on Thursday. And then we have the Fed actually, FOMC actually going to announce their results on Wednesday. And of course, everything they say is going to be very important. It's going to be gone over with a fine-tooth comb. This really is going to set the path for the market going forward. All of these issues that are coming to a resolution right now are going to be decided on and traded on in the second half of the year. So this is a very critical week, and we're watching all of these things with a magnifying glass.
Well, as Mark just pointed out there, this is a big week for Wall Street, from big tech earnings to key economic data. As he was saying, a lot for investors to digest as the S&P 500 notches another fresh record close. We're looking at the market action with Macquarie large cap growth team senior portfolio manager Brad Klattmeyer. Brad, it is great to see you. So I want to start off on those trade deals, Brad. Some greater degree now of perhaps certainty and clarity for investors. I'm curious, Brad, what did you make of those headlines, and what do they mean for the market?
Yeah, I mean, I think we're seeing what we would expect out of a normal progression. We came into the year with massive uncertainty. The market was myopically focused on that macro narrative around trade, and everybody backed off chasing momentum because they didn't know where earnings were going. Moved into the second quarter, we started to see visibility on trade, and numbers started to come back up magically as people reversed some of those impacts from the expectations of the trade impacts. So I think it's positive. I think what we're missing now is that expectations are for things to be really good. You're talking about big tech earnings. Well, they better be good because there's a lot built into expectations around that.
How would you so far, Brad, generally characterize this earnings season?
I think it's mixed. I think what we're seeing is obviously the tech names that have all this CapEx moving into them. We saw Google's results in terms of Google Cloud business perform really well, and I think we should see that from Microsoft and Amazon in terms of their AWS cloud business. I think we should see real strength there. But again, we have to. If we don't, we're in big trouble. These are trillion cap companies that are supposed to be monetizing this massive CapEx cycle. So we better see it. In terms of broadly, I think it's generally mixed. And you see that through the ISM manufacturing data. You see that through the ISM services data, where I think companies are really expressing some real pinch points and pain points around these existing inflationary pressures. You guys talked about the labor, how that is changing in terms of complexion. These are real conversations for companies that we're kind of dismissing because we feel a little bit better about the momentum in the market and a little bit more certainty around what's going on with global trade.
Mark, I want to get your thoughts on this earnings season too. We heard from the big banks. Now you got big tech on deck. Brad says he would characterize it broadly as mixed. Is that how you would put it, Mark?
I would agree, but I think we all came into this earnings season. Well, we're only a third of the way in, but we came into this earnings season with very low expectations. This was supposed to be the low growth performing quarter, and I think those have come in a little bit better than expected. Certainly the ones that I'm concerned about, but like I said, it's early days. We still have to see how this plays out. The story for tech is very different than other sectors, but so far it's sort of meeting expectations. Bar is low. Haven't been too many bad whiffs yet, but we'll keep watching closely.
Of course, Brad, we also have the Fed on deck this week. I'm curious what you think we hear from Jay Powell.
I think right now we hear the same thing from him, that they're still watching the environment. I think the message is that they still want to be certain that they don't get themselves back into a corner like they did previously in terms of those inflationary pressures being persistent. And I would argue, yeah, we are seeing some signals that those inflationary pressures are persistent. I mentioned the ISM data. We're starting to see prices tick back up across both of those. And that's meaningful, especially in the commentary from companies. And the problem is this time is if we move back into those inflationary pressures, I don't think that's good for margins broadly. So I think we got to really think through, if we do see that start to tick back up, then that's probably not a good thing for corporate margins and hence valuations.
Mark, does the market need a cut, Mark, to keep moving higher later this year?
No, I don't believe so. I think the market would like to see a cut. I think the market is factoring in 1 to 2 cuts at this point, and I think that anything that we do get out of the Fed, even if it's positive language, I think that could help out a lot. That can just sort of support the rally that already exists. But I think that there's enough of a tailwind to keep the market moving forward, even without the Fed rate cuts.
Brad, I'll get you out of here on this. When you're screening for opportunity right now, Brad, what are you screening for? What are the variables you're plugging in, and what are the names coming out?
Yeah, I mean, what we do with our process and the focused large growth process is always focus on quality. And as you can imagine, as we progress throughout the year, first quarter was really strong for quality, which we love. We think that's a persistent attribute for markets over time. And then second quarter, we kind of threw quality to the side. So we are seeing opportunities. You know, we have a sizable position in Danaher. So while you mentioned the biotech and the biopharma names are generally struggling, underneath that, what we can be confident of is these companies are investing significant amounts in CapEx. There's a lot of reshoring talked about in terms of drug manufacturing come back to the US. So we think that bioprocessing and life science and drug innovation and drug consumption are still on a positive path. So we're opportunistically looking in the life science area. Another place where we can find opportunity is while investors are optimistic about the potential for rate cuts, about the potential for some sort of improved growth prospects as we move throughout the year into 2026. We're not seeing that show up in the mortgage market yet in terms of expectations. So if you look through some of the financial names that are rather Intercontinental Exchange or Equifax, these are the credit bureaus or somebody rolling up mortgage technology where there's very limited expectations that anything happens in the mortgage market. We think there's some excitement there. We really don't have to pay for an improvement in the mortgage market, and you still get a really core business around the equity and futures around energy consumption.
Brad, as always, appreciate your time and those picks. Thank you.
Yeah, thanks, Josh.
Boeing set to release its Q2 earnings Tuesday following, we know, a tumultuous quarter for the aircraft manufacturer. Tariff uncertainty, an Air India crash in June, and of course, union contract negotiations. Investors are waiting to see the results of the last quarter. With more, let's welcome in now Yahoo Finance's senior autos reporter, that would be Praz Subramanian. Praz.
Josh, what do you want to know, man? Top line numbers here, but how are you going to do with the deliveries? But yeah, yes, of course. Big numbers tomorrow for Boeing. Expected to report 21.7 billion or thereabouts in revenue, which is a big improvement from a year ago when they were sort of weathering the storm of that door plug blowout with the Alaska Airlines flight. On the profitability side, it's going to be a loss of $1.40 a share adjusted there, with an operating loss of $161.1 million or thereabouts. Of note will be free cash flow or burn rate. Last quarter, 2.3 billion burn last quarter. That was a lot. It's supposed to come down a bit more, but still be in the billion range. So, still tough times there for Boeing, but at least they're sort of on the right path here with Kelly Ortberg, the new CEO. He's expanded, slowly but surely expanded deliveries. Now they had 150 deliveries of jets in Q2 compared to 130 last quarter and then 92 a year ago. So that's steadily improving. So that the game plan is here. How can he continue to improve deliveries, but then also get back into the green there?
What about the U.S.-EU trade deal, Praz? What does that mean for Boeing?
I think there was some concern before the trade deal that Boeing would be punished pretty severely by EU in the sense that they would tariff aircraft and, of course, aircraft parts from America into the EU. And, of course, Boeing still has plenty of jets in Europe still. The 737 MAX still is a high-selling jet, and it's a very it's a volume seller, and there's many European airlines and partners that would want to buy that plane. And it was concerned that would make that jet just cost ineffective compared to Airbus. So that seems to be sort of resolved with 15% tariff. Not great, but better than the 25 or even higher that was going to be potentially on the table. So that's a positive for them, and I think that's what is a sort of a breath of relief there for the aviation sector.
All right, thank you, Praz. Appreciate it. Coming up, preview of jobs data due out this week. Stay tuned for that. Companies trying to find a workaround on tariffs should be careful as the Department of Justice plans for a push to prosecute tariff evasion. For more, let's get to Yahoo Finance's Alexis Keenan. Alexis.
Hey, Josh. Yeah, I've been talking to lawyers to find out if their clients, their business clients, are a little bit worried about this new effort by the Justice Department. What they're doing is they're stepping up enforcement efforts for tariff evasion and putting criminal prosecution on the table. Now, that's a real shift that's now part of the broader Trump administration tariff agenda. And it's different because past administrations, including Trump's first administration, the route to prosecute, to go after tariff evaders, that was usually done on the administrative level, not really so much in the criminal realm, except for very, very serious offenses. Now, they tended to focus on keeping the controlled exports, controlled goods out of the reach of U.S. adversaries like Iran and China and North Korea. That was really the focus on the criminal realm in the past. But this new plan really is putting scrutiny on all types of importers, and that could be really a big headache for some of the smaller and mid-sized businesses. Trade attorneys can run somewhere around the range of $1,100 an hour, so not really a workable budget for a lot of companies. And also the stakes for a criminal conviction, they're high. They include jail time. They have steep fines, especially for intentional evasion. That can include forfeiture of an entire imported or exported product. Now, the DOJ really has its work cut out for it here because because there has been problems in the past with China and highly tariff nations trying to avoid these tariffs. But now when there are much steeper and broader tariffs across the board, those incentives, right, they shoot up. So the DOJ definitely, whether it's going to have enough staff to prosecute the way that it envisions, we have yet to see. Some of the common tariff evasion tactics are things like misclassifying goods and falsely claiming a country of origin. But we'll have to wait a little bit to see how this all plays out. But this is definitely a larger push. And the attorneys that I've been talking to say that these clients should really be getting their ducks in a row and reassessing their risk to make sure they have their products classified accurately. Josh?
Alexis, thank you. Appreciate it. The labor market is in focus this week, of course, with fresh data expected on JOLTS, private payrolls, and jobless claims, culminating in the July jobs report coming on Friday. Here with what to watch is Guy Berger, the Burning Glass Institute Director of Economic Research. Guy, it is great to see you. So maybe start big picture, Guy. If you look at this labor market, signs of cooling, Guy, but no evidence of crashing. And I'm curious, Guy, is that what you expected from this labor market, Guy? Were you surprised by it? I'm just curious to get your high-level thoughts.
So, I mean, the big picture thing is that the labor market's been pretty stable since last summer, last fall. The unemployment rate's right where it was, maybe even a little lower than it was July 2024. The JOLTS data on hiring and quits has not really budged recently. It's better than I thought. I thought that the tariffs, even the lower ones that I think we were realistically going to converge to, would reduce employers' confidence in hiring, and it hasn't yet. And it's a good question why it's not, and whether that's going to change this month or in the next few months, or whether we're in this period where things are going to be stable for a while. But I'm paying a lot of attention to tomorrow's JOLTS data just to see, is that level trend in hiring quits? Are they going anywhere? I mean, is it even possible that given all the constraints on labor supply that we're seeing from the immigration side, they might start going up as employers start scrambling for talent again? All these things are possible because there's such big policy changes on so many dimensions, pushing the labor market in different directions.
So it's better overall, Guy, than maybe you would have expected. It's remained steady. And to your point, listen, a lot of moving parts, Guy, but as you try to model, forecast how you see the labor market evolving over the next few quarters, Guy, what do you forecast? What do you see?
I mean, if I had to guess at this point, I think the labor market should be weaker at the end of the year than it is now. And not just weaker employment growth, which you know is going to happen again because that immigration issue, lowering the break-even rate of employment growth, but just because tariffs are a big tax hike, offset partly by some of the policies being implemented from the big fiscal bill that just passed. But in general, fiscal policy is a little contractionary. Monetary policy might start moving later this year, but is reluctant to do so. And so there are a lot of forces squeezing the economy on the margin. That's going to make hiring a little weaker, even if it doesn't cause the economy to fall off a cliff. I mean, I think that some of the very pessimistic takes were wrong, but I think the mildly pessimistic ones, time will tell, but I think are probably going to be vindicated later this year.
Mark, I want to bring you in here as well. So Guy brings out his crystal ball. He says, you know what? Labor market could be weaker. Is that what you see?
Yeah, it's interesting. I mean, I agree with Guy in that labor market's holding up a lot better than we thought it would. But going forward, certainly quite right. I mean, we definitely anticipate that there's going to be a little bit of compression on margins. And then, of course, when companies feel that pressure, the first thing that they do is they cut the labor force. That's the easiest variable cost for companies to cut. So there could be, and as he said also, worst case scenario, you could see a little bit of pressure on the labor market. But we also have to factor in so many other things now. It's such a complicated environment, such as the immigration workforce, as we talked about earlier in the charts. It's just a very interesting market to focus on right now. But for the most part, it is holding off. It is holding up. We're still waiting for those bad numbers to hit across the board.
Guy, so Mark did mention immigration there. In terms of Trump's crackdown on illegal immigration, Guy, where are we seeing that, if at all, show up in the data?
So first, one obvious place we're seeing it is weaker employment growth than a year and a half ago, despite the fact that unemployment rate's actually in a better trajectory than it was. It was going up a year and a half ago, and now it's flat. So clearly we don't need as many the job increase every month that is needed to keep the unemployment rate flat is much lower than it was. Beyond that, more granularly, I mentioned hiring and quits being flat. If you look at the leisure and hospitality sector, and in particular, restaurants and hotels, accommodation, food services, you're starting to see hiring picking up, quits picking up, job openings picking up, maybe even layoffs coming down. This is the kind of behavior you would expect in a sector where labor is scarce. And we don't see it across the broader economy, but this is a sector that's particularly sensitive to immigrant labor with, a bigger crackdown on illegal immigration, but also probably more restrictive visa issuance for all sorts of seasonal labor. It's probably squeezing the sector. The sector is having a little bit more trouble filling positions than it was a year ago, even if they're not quite at the extreme post-pandemic labor market shortage we were talking about 3-4 years ago.
Finally, Guy, I'm also curious to get your take. Are there themes and trends, Guy, in the labor market to call out in terms of generational differences? Specifically, I'm very curious what's going on with younger Americans.
Yeah, I think that if you are an older person, I mean, older as in, in your 30s or beyond, and you have a job, the fact that hiring's week's not really bothering you that much. Maybe a little if you want to switch, but you're a very low risk of being laid off. If you're a young person that's looking for your first step on the career ladder, and this is whether you're a college student or somebody in their late teens that just finished in high school, it's hard. Unemployment rate for these groups has gone up a lot, even though overall employment has not gone up very much. It's tough if you have kids around the house or nieces and nephews, or even yourself, a person in your late teens, early 20s. This is a tough time to find a job. It probably feels a lot like the mid-20 teens, even as the rest of us with jobs are doing relatively well.
Guy, great to see and to have you on the show. Appreciate your time. Thank you.
Thank you.
Time now for to watch Tuesday, July 29th. We're going to start off on the earnings front. We're going to be getting another big batch of earnings on Tuesday, including United Health Group, Boeing, and Starbucks. United Health Group announced results for the second quarter. The outlook is in focus for the health insurance company. Analysts expecting it won't bring back its 2025 forecast when it reports Q2 earnings, but investors may feel reassured if the company sounds more positive on medical cost trends compared to peers like Elevance Health. And taking a look at the monthly consumer confidence data for July, that's coming out on Tuesday. Economists forecasting that number to tick up compared to June to 96, signaling people are feeling more optimistic about the economy as President Trump's trade deal deadline approaches on August 1st. And finally, we're going to be getting monthly JOLTS data. That's the Job Openings and Labor Turnover Survey. Job openings expected to drop to 7.6 million, suggesting employers are posting fewer job listings. This all coming ahead, of course, of the full July jobs report on Friday. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.